In 2002, he transitioned to Nordea, where he managed a 350 million fund that grew to an impressive 3.5 billion euros by 2007. Along with a partner, Leon left Nordea to co-found European Value Partners. In 2014, he sold his shares in the company and joined European Capital Partners as Chief Investment Officer. While a significant part of his role involves managing the company, Leon's is passion for value investing, so he keeps actively managing equity funds. Leon, besides being a CFA charter holder, was also one of the founders of the CFA Society Luxembourg. Our next guest is Alirio Sendrea, CFA. He's the head of research at Invexcel, a family office based in Madrid, Spain. He has been a buy-side equity analyst since 2015, employing a bottom-up approach. Alirio leverages on his previous experience in financial analysis, valuation, auditing, restructuring, treasury, and risk management, performing key roles in leading global companies such as Barclays, KPMG, Procter & Gamble, and Deloitte, where he gained valuable insights on different industry fundamentals. Alirio also serves as a visiting lecturer at EADA Business School of Barcelona, teaching value investing class. He also teaches CFA preparation courses at various business schools in Madrid. Finally, we have Jorge Guimaraes, CFA, who has navigated both between the sell side and buy side throughout his career. He began in 2000 as an analyst at Bank Financia before moving to Allianz as a portfolio manager. In 2004, he joined BANIF as an equity analyst and moved in 2006 to the asset management division as a portfolio manager. In 2015, Jorge transitioned to Haitong as a sell-side analyst covering utilities. And in 2019, he moved again to Spain to work at JB Capital Markets, continuing his role as a sell-side analyst in the utilities sector. So thank you all three for being here, for taking the time to speak about your careers and helping our audience to understand what really an equity research analyst does. So before we start, maybe ask Jorge Guimaraes, which has the experience both in the buy side and sell side, to tell us a little bit more about the differences between the two positions and how he transitioned between them in his career. So, Jorge.
Hi, good afternoon, everyone. In the end of the day, there are aspects that are similar and differences. We all are supposed to set or to have a word on the value of financial assets, on this case about share prices. The difference is whether you define them for the portfolio of our portfolio or the portfolios of the firm that we belong to, or we sell. In the end of the day, that's what equity research sell side is all about. We sell our investment advice to third parties. In the sell side, there is a watershed moment in the European regulation, which was around 2018 with MiFID, that led to a separation of the payments for research and for trading. And this was an important moment because it had an impact in how the brokers are remunerated and a relevant impact in the demand for analysts and how the payment is structured. But the primary role, I would say, it's similar. It's have an opinion about the value of the financial assets or the equities on this case. What differs is primarily is the scope where you act, and up to a certain point, the speed and the immediate consequences of your calls. Because if you are simultaneously a portfolio manager and an analyst, you analyze the asset or the share, you take your decision and you execute it. If you are a buy-side equity research in a larger house, probably you may have your view, but the PM could have his final word. And for myself as an equity research on the sell side, I give my advice to third parties. They may agree with me and execute. They may disagree with me and do something else completely different. But on the role itself, it's interesting that over recent years, more than the clients follow directly our opinions, the clients, and the more sophisticated they are, the more I would say clear is this trend. The client very often wants to validate his or her own view and values the analyst for the way he makes him or her think, or the different views about a certain matter. Clients, when they are sophisticated clients, they tend to have more information than, in most of the time, I'm talking about big hedge funds or big funds, they have more information typically than the equity research, and this goes for a local broker like ourselves, but goes also for a global bank in London. And very often what clients want to hear is how we think about a certain matter. They have their own view, their own numbers, but they want to confront that view against a different view to improve their investment decision process. This is how I would put the question.
Yeah, and just maybe to give an overview also of your career, may you tell us the differences between your daily tasks when you were in buy side and now that you are on the sell side? So the typical daily tasks that you would have in each.
Yes, in both cases, the day tends to start with a morning meeting before the opening of the markets. Actually, as the time went by in my career, that morning meeting was more and more earlier and earlier in the day. As of today, we have our morning meeting at 7:35 CET. So, and market opens at 9 CET. So we are now 1 hour and 25 minutes before. Typically on the buy side, we at the morning meeting we discussed the news flow and what recommendations of brokers there were, but more effectively the news flow and what we should do in our portfolios, if anything. And while on the sell side, you typically have to write. So that is the big difference. The big difference in the routine is that on the sell side, you do the morning meeting, then you have to write either formal documents or comments to clients. You have to communicate that to the clients. There is also some type of difference between the workload in terms of the reaction to the news flow. And this relates with how you need to manage pressure in both sides of the fence. Because when some news comes by and you are in the buy side, and what you want to know, what you need to do with your position, either your direct position or what you need to do to say to your PM. While on the sell side, you need to quantify it, write your comment, and then distribute, or making that your firm distributes your view. So this, as a consequence, for instance, if you have let's say a capital increase or result after markets close, in the buy side, you do your numbers, you speak with 2 or 3 analysts with the company, you get your view, and that's it. In the sell side, you do your numbers, you speak to the company, and then you have to write a report to publish it. So this typically means that the while the pressure is is strong in both sides, the workload is a bit different. You tend to have longer workloads in the sell side than in the buy side, although the level of pressure, I would say, it's similar, at least for me, because if I have a client with a position that I recommended, if it goes against me, I'm as worried as I would be if the position was on my own book. So, but there is this little difference in the types of workload.
So if you want to work a lot, go to the sell side, but you don't have the neck in the responsibility. But if you go to the buy side, the responsibility falls on you, even if you trust about your sell side analyst.
I would just add, João, sorry. I would just to add. I would that goes
Sure.
from person. It goes from person to person, because although I don't have my neck formally, if I said something to the client, I feel like the position is mine, and I believe most of my colleagues feel the same thing, because we want to give the client the best service possible. So I would say probably that with this little in the sell side you have the workload and the pressure. In the buy side you have the pressure. If I had to define, but my colleagues that are still in the buy side, probably I don't know what they will say about this.
So let's maybe move to Leon. Leon, you were working in Nordea as a portfolio manager for 5 years until 2007. And amazingly, you decided to leave in 2008 and found your own company. So may you tell us how was the work as a portfolio manager in Nordea, and why did you decide to leave and found the European Value Partners?
Okay. Well, to answer the question, I think I need to go back a little bit further away, because my whole career was about passion of investing and about value investing, in which caught myself really since the start. And I had the privilege always to be on the buy side, and I had the privilege to be able to find people who invested with us and or work in organizations that allowed me to do what I like most. So the word pressure was more felt as a fiduciary duty and a privilege. And I think there was one fundamental difference, that when I started in the business in 96, actually I was a buy-side analyst and portfolio manager, but catering to the whole private banking and to the internal funds. So we actually could not specialize at all. And I think for me, one of the biggest key things was that I needed to cover a lot of things, even if I didn't like them. It was very hard for me to analyze a company and come back with a hold, or even with a sell. Okay, we're not a hedge fund, we're not shorting, but I just thought, and then I had this opportunity to move to Nordea and manage that. Nordea were two portfolio fund managers on that fund. And we actually picked around 40 companies in Europe out of a universe, flex cap, more than 1,500 companies. And we basically really did our research only to come up with an investment decision, and that triggered a view, and we looked at the view, and we are still looking when I'm still managing these kind of strategies. I look at the world through my investment philosophy and process, and I believe that's a fundamental difference from mainly the sell side, because there you are covering a sector, you have opinions, you have, but I think it's a kind of a different mindset, because I could, as a buyer of sell side research, I could also, well, to be perfectly transparent, I did not even look at the rating the analyst put on, the sell side analyst put on the stock. What I was interested in was in the analytical content of how could I quickly analyze this company and maybe learn something I did not know. So it's a different mindset, because we had our own valuation models, which come more from the value camp. We looked a lot at earning power. We did not build really DCFs. We looked at discretionary free cash flow in our approach, and that was different. So to come back to your question, when the only thing that drove us was the management of our investment philosophy. And when we resigned from Nordea in 2007, it was not because we didn't like Nordea, but we thought that it was a huge opportunity. And you imagine 2007, it was just before the financial crisis, so the timing was really awful. We just thought our investment philosophy is, our approach, our track record is so good that we can dare to jump. And like sometimes courage is rhyming also with, in a way, stupidity, because I did not really foresee first the financial crisis, as not many people foresaw it. But I also, at the moment, was a little naive that I could launch immediately a new fund and bring it up. So, but we were lucky. And actually, Nordea came back to us and asked us whether we would become their first client. So, so we basically continued in our own outfit exactly what we did before. And it was all about picking undervalued earning power in Europe, 40 positions, and being as close as possible to these companies, seeing the companies directly, and it was a huge privilege. I think in today's world, it's fast forward today, it's much more difficult. But we were lucky in this. So our life, so I recall, for example, I was invested at the time, and this is just to put a name. I was invested in AP Møller Maersk in Denmark. We called up the company, and 2 weeks later we had an appointment with the CEO at the time, and that was due to the scale of that fund, but also it permitted us to spend days just analyzing the company and learning on shipping and reading and of course also with the help of the sell side. That was really exciting, and I think it's but I didn't recall that we had early morning calls or we didn't have that. It was a continuous journey process. Yeah, well, I'm very grateful for the journey investors helped us to have.
Yeah, so despite the timing, it was a good decision.
Yes, certainly.
So, Alirio, You started your career a little bit in a different way. So you started as an auditor in Deloitte and then also in KPMG, going in the meanwhile through the finance department at Procter and Gamble. So may you share with us how helpful were these experiences in your career and in your current role in buy side at Invexcel?
Sure. Well, first, thank you very much, CFA Portugal, to you, João and Pedro, and for having me. And it's a great honor to be here with Leon and Jorge. And yes, I'm the outsider here. I've been 10 years working with markets for now. We're directly working with markets. I've been working for listed companies for many years. Well, I initiated my career. I'm a CPA by profession. I come from Venezuela. I started as an auditor, and by your mind for your whole life. So coming from a developing country and being an auditor for sure made me a paranoid optimistic. So obviously I think things could be better, but I'm all the time looking around because I think somebody came and stole my money. So and I moved to a better life from Venezuela to Spain, and I got to Spain 2007. So in the worst time ever, I think, in modern history. But we're used to that because I was grown up. Well, actually, I was born in a month after the collapse of Venezuelan Bolivar. So I have not known any time in my career without issues, or in my life, in my whole life. Devaluation, inflation, that's been part of the game to me. So coming from auditing has that from a developing world, and it helps a lot. It helps a lot because you always think in the worst to happen. So we're very stoic by design. So you're always inverting. I think it's very important, thinking what can go wrong. You look at an investment idea and you say, well, what that company is moving up, what can go wrong? So that's a question you always ask. And I have, for example, from time to time, I have I'm a value investor like Leon. Let's speak really open here. And I know many people all around the world that they love the very famous Buffett partnership from the 1960s. So they say, well, you need to be concentrated to invest in 10 names. And I've been an auditor, so I've been auditing companies where we as auditors don't find very important stuff, and the CEOs of those companies and the CFOs they lack a lot of information, because in very large companies it's almost impossible to have all the blind spots covered. So that's an example of why to me is very important to the diversification. So we don't do 10 stocks in our portfolios. We do something close to Leon, so around 40. On top of that, being an auditor and working in the belly of very large corporations in the financial sector and in a very large corporation, Procter & Gamble, and as an auditor, I work doing auditing and consulting this stuff for many large international companies. That helped me a lot to understand fundamentals. In the end, that's the most important stuff, understanding how companies make money, what are the main risks, what they do to mitigate them, how the capital allocation works, if the capital allocation makes sense or is destroying value. To have a look at the balance sheet. So I that kind of guys, the kind of guys that are disappearing these days, with the booming markets, that spend time looking at annual reports, at annual accounts. I look at what's going on there. Obviously I don't spend 5 days reading annual reports of 300 pages, but I spend some time, a few hours, going to the hotspots from in my experience need to be looked at in the not only in the face of the annual report in the financial statements themselves, but also in the footnotes, which are very important. And that has helped me a lot. Obviously, I'm biased in my answer, no, because I'm some sort of a guy with a hammer, no. So these things look like a nail to me. But I've used that experience to make money.
Great. So it's great also for the audience that most of them are students to know that the path doesn't have to be always the same. You can have different paths, and they may actually help you further in your career. And talking about paths, Jorge, in the beginning of his career, went through the painful process of pursuing a CFA certifications. I think despite painful, I'm sure it was very useful. So Jorge, may you tell us briefly how it helped your career having the CFA?
Yes, actually, I did the levels 2 and 3 simultaneous when I was taking my MBA. So, and I was working and making money to my company. So it was a bit of 2 amazing years. Probably some of the best of my career. So one thing that really helped me, it opens you a broader horizon in terms of the investment themes that we have in this call, persons from very different academic origins or university origins. But at least in my personal case, my knowledge in terms of fixed income was very limited when I came out of college. And the CFA helped me a lot on that part. All the stuff about fixed income and derivatives that, because at least in Portugal, and here, sorry to resort to my own experience, but in Portugal, when I took my university degree, there was a big bias for equities. Well, the most of the assets in the markets are not equities, but the university gives a big bias to equities, and so all the knowledge that I got from in terms of fixed income derivatives was very, very useful in my personal case, and also all the body of knowledge about asset management, because it was a bit, when I did it, I took this in 2002, 2004, so a long time ago, and it was pretty much US oriented, which is good because we work on an European environment, and in terms of asset management, US is still more. Back then, it was more advanced than we were, and I believe we could discuss this, but it's still some years ahead of us. And so it was interesting to look at their perspective, but effectively it added to my intellectual background that helped me in my career later. Actually, when I took both courses simultaneously, I was considering to move out of Portugal. That finally did not happen. But I would have the tools necessary to go out of Portugal, because it's a certification that is recognized worldwide. So I would have a better tools to go out of Portugal. So it was very useful, to be fair.
That's great, Liam. What about you? In what cases did the CFA contributed?
Well, first, I would completely agree to what Jorge said in a very explicit way. At the time when I did it, in Luxembourg, at least, there was not really any knowledge on the CFA program. Okay, and I had an acquaintance who did it, and then I told myself, why not? But right now, and as late as this week, I was pushing here one of the my portfolio managers in the team to go through the program, or to present him the advantages of going through the program. And I believe it gives you, because we are all specialists early on in one area. And as Jorge also very rightly said, I think if you analyze companies, you need to have also sometimes a broader knowledge. And you need, even if I'm not an expert in Black Scholes models on options, I at least need to understand what drives the price of an option and what the impact could be. And so I believe it was a very useful journey. And if I'm perfectly honest, I think, and I cannot, of course, certify this, I would never have had a headhunter calling me to go to Nordea if I didn't have the CFA program. Because it was at the time a kind of the driving license to be active in the industry. It became rapidly, and it was here a competitive advantage because I was not a commodity in a way. Because the business school I went to in Scandinavia, nobody had heard of. So it was not due to my university degree that I was looked at. So this is for me a very important point. I know that today the results of the level 2 program came out, and I hear that it's below 40% success rate in level 2, if I read the headlines this afternoon correctly. It's an investment. It's a substantial investment. I recommend to everybody to go through the program before starts a family, because if you have your family waiting at home, I think it becomes more difficult. So I think it was definitely worth it to go through it, and yeah, I'm positive on it.
That's a very good point for our audience. So you know that if you want to pursue a CFA, do it now. Do not wait until you have responsibilities. Otherwise, it may compromise those responsibilities. Alirio, anything that you want to add?
Well, I think almost everything has been said. No, in my own case, has been also transformational. Maybe I can share my why I did it and my special circumstances. And you already mentioned that I was an outsider. And by the time I realized I didn't want to spend more time in as an auditor, risk manager, or whatever in the corporate world, but wanted to work in the make an investment profession. It was very difficult, not only because of that past. No, it was some kind of a stigma. So I found a lot of people looking for me to be an auditor, whatever. I didn't want that. But on top of that, were very difficult times in 2010 in Spain. So we were just in the middle of the W of the Eurozone crisis and the special Spanish fiesta we had here with the real estate stuff, which took long to digest. So I look around and say, well, what can I do? So here in Spain, we have very good business schools. So they're very well-renowned masters in finance. And I look at that and say, well, maybe because of the situation here in Spain, in the end, I may have to move to another country. Maybe I need to move to the US, to London, whatever. Luxembourg was also in the play, and I will suffer from something, no, because I came from Venezuela and my university was not listed when I was looking for jobs in very large institutions, and say, well, that will happen again to me. So I need to look for something that will be recognized in the whole world. I looking for the golden standard, and gold to me is something which is very important because I was a swimmer when I was a kid, and I always I will push hard for the goal, because when I do something, I do it with my whole heart. So I said, well, this is the gold standard. I remember speaking with friends who were in the program, looking to the numbers, the approval rates under 40%, and I love that. I said, well, this is a competition. We're in hard times. I will go there and compete, and I will show something to whatever recruiter company in the world that this will be a level playing field to me. So nobody will say you don't speak English. Nobody will say you don't know about this or there or whatever on valuation or whatever, because I will pass those 3 tests first attempt. And I put a challenge to me. That's the way of I do my stuff, and I made it. And during the program, it helped me a lot because I was working for a financial institution with issues restructuring. I was working with a lot of helping as an internal advisor, helping and several departments to rebuild many broken stuff in capital, in securitizations, selling businesses here and there in Euro, then restructuring. And the CFA paid off from level 1 to me. Once upon any given day, I remember a guy who in the end happened to be my boss. I was working in an internal risk management team, and the guy came to me and say, "Well, I want to talk to you. Let's go for a coffee. I knew from your boss that you passed level 1 test of the CFA program. By the time in Spain, nobody knew about CFA. Okay, this guy was an American. He came from America, and he used to be the treasurer of Barclays Global Advisors for many years in San Francisco, say." And he said, "Well, I tried I joined the program, the CFA program, and I didn't pass. And I was the treasurer at Barclays Global Investors, and you passed the test. I will restructure this business here in Europe. By the way, after this meeting, you will go with me and you will sign the NDA. And I want you to work with me." And that was transformational in my career. Not only obviously in salary, in exposure in the organization. I began to speak not to directors, but I began to speak with MDs, CEOs, chief of staff, CFOs, country and regional level, and preparing stuff for global CEO of the company, visiting London and learning a lot directly from the table where decisions were taken. And that I owe that to CFA level 1. And level 2 and level 3, I learned a lot. And it's something that is very, very, very valued in my job where I work, because I'm the only guy who took the CFA, and you get a really good overall knowledge. I'm specialized in equity markets by working in a family office, so we do many other stuff, not only equity from time to time. 100% of my time is equity, but the other 100%, Jorge, we work a lot also, not only you, guy. We do M&A, we also invest fixed income, we do alternatives, and we also manage portfolios for our close family and friends. And you cover all that in the CFA program.
That's great, because we were going to try to promote a little bit the CFA here, but I think you did all the work for us, so we can move on the questions.
I'm not being paid, can assure you.
Moving to Leon, you have more than 20 years of experience in different firms, and throughout these 20 years of experience as portfolio manager, you went through several crises, you went to several technological changes. Since you started working, you went from almost no computers being used to now the age of AI. May you tell us a little bit, how did your investment strategy evolve throughout all this time?
Or, well, that will be a very long answer now. Well, first, I'm not so old. We already had computers when I started, but I recall we had the Bloomberg with a trackball. You may remember, Jorge and Alirio, the keyboards we had with, which were a little different than today. I think the history of value investing goes back to the 30s of the last century, to Benjamin Graham. And this idea to buy to value a company and to buy at the so-called margin of safety, at the discount to fair value, and then let Mr. Market discover the fundamental value, and by this doing, creating returns. That has not changed. Technology did not change this. What has changed, however, enormously, I believe, is also the access to information, but also our ability to digest this information. But if I just look at the European stock market, for example, I think, and what Jorge mentioned was the arrival of MiFID in sell-side research. I feel that the amount of sell-side research available has vanished in some smaller and medium companies. And that has a direct result. The price-finding mechanism of the stock market, to some extent, has also been under pressure. Then you had passive investing, which, in my humble opinion, is still the ultimate momentum trade you can do. Basically, it's completely disconnecting from the undervalue, from the fundamental value of the companies. However, what I can say over my whole career, whenever I made a bad investment decision, it was mainly for two reasons. Either I bought a good company at a too high price, or I had missed, or second reason, and it was mainly that, as value investor, I had misunderstood the fundamentals of the company. So the risk of every investment was always linked to the fundamentals. And not, okay, we have all this data floating around, but at the end of the day, a stock price is always a little bit like a vote of the moment. It's his famous voting machine in the short run from Benjamin Graham. So in my opinion, what I learned is, at the end of the day, when you invest, you become a shareholder of a company. It happens to be a listed company, but also we are also here doing private equity and real estate in our company. The basic thought process is the same. It's more difficult, I find, in private equity, in unlisted asset, because you don't have track records quite often. You may lack some audited statements from history in startups, but I believe the essence of investing remains the same, and technology does not change that. Technology is an accelerator, but a foolish idea is still a foolish idea. When the internet bubble burst, I think there was a fundamental difference to what we see now today. I watched the NVIDIA presentation now recently. Well, there's an enormous revolution, in my opinion, going on. What Jensen, their CEO, explained. I think with artificial intelligence, there's something really happening. And we have now, compared to the internet bubble, companies that produce earnings. They have earnings. They may be highly valued, but they have earnings, and there's a revolution coming on. So somebody turned off the light because I was talking too long. But I believe that the fundamentals of investing has not changed. I'm a big admirer of the work of Professor Greenwald, who wrote the famous Value Investing, and who wrote now a second book on value investing that came out, I believe, 3 years ago. But the basic principles, they are not changing. It's all about assessing the fundamental value of a business and looking at the fundamentals of the business. And that is what I like about this job. And that has not changed.
Alirio, picking on what Leon said on the investment strategy, is it yours that similar, or how do you see the investments that you do?
Well, quite similar. Well, the value investing approach is broad. There are people who still try to pick up the cigarette butts from Graham-style ones, and it's very difficult to find them today. Let me explain myself. Sorry for this. It's the Benjamin Graham, who was the guy who incorporated the value investing approach to investing. By the time he was an investor, he was very easy to find after the 1929 crash and up to the 50, 60 when he retired. You found companies trading for less their equity value, and even for less than net working capital. Today is very difficult. Tied to what Leon said, information flows easily today. So those kind of price valuation gaps are very difficult to find. But from time to time, they appear here and there. And from that way of doing, to people to do their money investing in compounders, companies that growth with a lot of growth potential, with massive entry barriers, and in the middle you have a lot. You might have restructurings, special situations, cyclical stuff. We do all of them, to tell you the truth. So we're looking to the market. We go where we see opportunities. So we are open to invest in a compounder, in a company. But the important stuff to us is price we pay in the end, because it's simple. It's simple math. You may buy a company which value, for example, 200, whatever monetary unit it is. If you buy that company for 100, makes a lot of difference instead of buying for 150. So we try to buy 200 stuff for 100. That's what we try to do. And the opportunity set depends on market situation. From time to time, we have some negativity in markets, and we find opportunities to buy companies reasonable prices with very large, very solid competitive advantages. From time to time, and they're not easy to be picked up. And from time to time, we find restructurings, but we limit restructurings to industries we feel and businesses we feel we understand a lot. Yeah, because they're very dangerous if you don't know the business. We do a lot of cyclical stuff. Companies that maybe they operate in a competitive market. We know that, but we also know, because we feel we understand the business. We've been around for many years. That those companies will be there in 5-10 years time. We don't know in 30 years time, but in 5-10 years time they will be there. And we play the cycles, and we play the cycles our own way. So we play the cycles, not only looking at demand and forecasting stuff. We don't have crystal balls. We focus a lot on fundamentals, and in this very case, what we try to do is to look what's going on in the supply side. So we are quite open in the value investing landscape. The important stuff again, it's we need to have some confidence. If we're buying, we have more better information than the guy who is selling. So circle of competence is very important. And obviously we work in improving our circle of competence, but we do not invest a single euro in a company. We have no idea how they make money. And we miss some good opportunities, but that's a very important risk mitigating rule to us. And say, well, we lose that. Let's learn about that, and maybe we pick it up in 5 years' time. We invest family and friends' money, our own money from our family and friends, and thanks God, we have the ability to be patient, which we think is a competitive advantage in this profession. And we take advantage of the short-termism on the market. Actually, we have conversation with people from the sell side, and we get good opportunities from them, asking what they like, but their boss didn't want to push to the market. So that's a question with those guys. We have good rapport, good relationship. We ask, and we play stuff like Leon for us. He mentioned AP Monomers, for example. That's a company. We bought a 2-heater here. We doubled our money with this company a few years ago, and again, so that by the time we bought the shares, nobody on the sell side. I think by the time 20-25% of the analysts following the companies had a buy recommendation. So we went again against the market because we had the knowledge. I have in my family people working in the shipping industry, so I got a lot of information. After a barbecue, I got many information from my brother-in-law, and he introduced me to his bosses. He works in a very important shipping company in Hamburg, and I began to gather. And after 2 years, I put to work my first euro in the industry. After 2 years of studying the industry, and that paid off. From time to time, they develop quickly. From time to time, you need more patience, but that's the way we do it. So I think it's more or less similar. Earning power, value, cash flows, avoiding leverage, understanding what you have in your hand. It's the rule of the game.
That's amazing, especially the part of the confidence, because it's really the most important part, is that you are confident with your investment when there are some piece of news that may shake the market and put the market in fear mode and drive your stock down. You are confident, and maybe you can
let me put something here, which is very important. Confidence is important, but we're paranoid all the time. We're always thinking somebody can steal our money from our own pockets. So we're looking everywhere, trying to gather different information, speaking even with people who don't like the company, other asset managers, other analysts, sell-side guys, competitors, whatever, our companies in the value chain, to see. We try to look at the blind spot. We say, well, when I said information, we try to get more information than the guy who is selling to us. And the other way around, no? So when we play cycles, we would make our own money and sell to other guys who make the marginal euro, the marginal dollar. But we're paranoids here. It's non-stop job.
Yeah. So maybe picking also on that point of the information and about when certain news come and maybe the market starts to be a little bit with fear about a certain company. I would like to ask Jorge, because he's a sell-side analyst covering utility companies, and there was some piece of news coming recently from a statement from Donald Trump that he basically was saying that he would suspend all the renewable wind projects in the US after he takes the presidency. So, Jorge, you cover utility, so you had to write and to maybe adjust like the models. What did you do after this piece of news?
So the thinking process, the first thing you need to understand whether the new news is what is the differential impact versus what was known before. The speech I mentioned, I believe, is that in the past the market was expecting Donald Trump to suspend, to put on hold the developments of offshore wind, but on that specific news conference he mentioned wind, so the market worried about all onshore and offshore wind. So that was the reason why on the following day the exposed stocks had a very bad performance in the market. So the first step you need to understand is this new? The second point is what will be the impact on the companies that we cover, and the third step of the process is to, once we did our appraisals of the potential impacts on the companies we cover, communicate that with our clients. You can do it either through immediate means of communication, immediate emails or chats or so. If it's something really relevant, we would have to adjust our valuation of the companies and publish updated estimates and updated valuations for the assets. But most of the times, what we are required to do, the more often situation is that you are asked about the impact on the value of a company of a certain news. So that is probably the most common situation. It's not that often that you need to publish new estimates and new valuation for companies. Also because if you're talking about an impact of 0.2%, you're not going to publish anything new. But if you're talking about an impact of 10% or 15%, probably you do need to publish. So this is mostly the production, let's call it like that, the production process. You need to process the information, assess the new impact of it on your companies, and produce a content that gives to your clients your assessment of that impact.
So do not go and buy and sell companies based on what you read on the news. Try to analyze them first and analyze the impact, because otherwise you may sell a company just based on the news. I'm talking to the students. Don't sell a company because it's so bad news, because maybe in the end the impact is very, very, very low. And so I don't know if there are questions from the audience that we may address.
There is one. I can read it. It's a great question from Steve Abernit. I'm not know if I spell correctly. Sorry if I didn't. The question is, what if any impacts are in LLMs? So LLMs are large language models, having on the process and responsibilities of equity research practitioners, particularly in terms of analysis, modeling, and or composing reports. Basically, the impact of the AI on your job.
Maybe I can shoot first.
Sure.
If you don't mind. Well, actually, I had a meeting this very morning with my provider of financial data, and understanding how this works and the tools they have set up here. I think it will play a role. We're still playing around with the models. This is quite new. We're playing with ChatGPT, Gemini, Notebook. We're asking questions to see how it works. It's something we have some plans during the coming weeks, actually, to do some tests, but formal tests to see if we like what we get from there. But again, there's something we have in our mind. We won't rely on this 100%, because this in the end, if you know how this works, you know the how internally works. It's these models. It's an statistics model. You know, they some ones and others, and they give you the average answer. If we want to get more in this very competitive world of where, as Leon again he mentioned, where information flows openly, widely, and is more cheaper than 2, 3, 5 decades ago, you need to have an edge, and you need to develop that edge yourself. So if you're using what everybody else is using, in the long term, we think you won't get those results. You won't generate alpha. It will be there in our process for sure. It will help us, but won't be the key driver for sure. It will add to the process.
If I may also jump in, I believe it's really transforming the way we do our work. And I believe these models, and I saw some, and there's also one actually developed especially on value investing by somebody who lives now, Luxembourg, I believe he lives now in Spain, Candy Carrera. He actually popularized kind of, you can look it up on the internet, a model where basically with the task to feed in a kind of the way of thinking of a value investor into such a model. You are absolutely right that you get, it's a statistical model, so you get basically a kind of an average, a probabilistic figure, and you will probably not outperform. You will be average in a way. However, where I think it's really a game changer, in my humble opinion, is that a lot of the heavy lifting in analytical work can be done. To build a model on a company, actually to feed in the information in your model and basically sum up some research. You imagine if you can take the hours and days of research done on sell side by you and publish somewhere and feed them in a model and get them summarized. I think, well, you have a disadvantage because you are not talking directly, but you can absorb more and more information, and that can be very helpful. But I think information could even flow quicker and in a way make markets more efficient. So make it more difficult for the gray head like myself to outperform the market. So I believe it helps for the heavy lifting. I believe these models are not always perfect. If you are looking for facts, probably they may put you in a direction that statistically or in an optimization model that is the most probable, but it may not be correct factually. So, but I think we are at the beginning of a huge revolution, and it's not only affecting our industry, and I'm not definitely as value investor saying this time is different, but I think there is something changing, but the human brain and our ideas, I'm not convinced that they will be replaced soon. I saw examples on robots powered by artificial intelligence. Apparently, the biggest task right now is to find a robot or have artificial intelligence putting the dishes in a dishwasher. That's apparently an unsurmountable task. It's very, very complex, difficult. So the human brain has something that is not yet matched, but maybe mine in a couple of years, but certainly not yours. So exciting times.
That's very troublesome, Liam, because I was hoping that a robot could do the work for me, besides washing the dish, to put all the all the dishes on the machine. And just to pick on Jorge Guimaraes' experience, Jorge, do you think AI will affect the sell side?
No, definitely. Here, the types of outputs that each of us is required to produce influence a bit how the AI impacts. First, as a general principle, we are talking about faster processing of information, so more efficiency of markets. I fully agree with what Leon said. On the specific case of sell side, I believe AI will speed up all the less value creating processes, such as, I give you a day-to-day example. We typically resorted to others, since most of my team is not native English speakers, but we can simply replace it through AI powered editing softwares, and they are significantly cheaper than the editor. So the problem, what I hope will not happen, is that if my clients think the same of my research and replace me by an AI model. And that the clients of my clients do the same with the robo advisor with the funds of my clients. So this is, I believe, that is the threat of the AI. But it's a huge leap forward. It will speed up the production process in our case, because we write smoother and faster, so we can produce quicker. And this is here, there is this big difference between the sell side and buy side. So the output to my client, it's a step that takes me time, and through AI I can speed it up significantly, probably. So that there is a, but then you have also some legal challenges, because most of my AI models are machine learning in the end, and most of my content is mine, so it's copyright protected. I don't want to share my knowledge with the machine, otherwise I would be running into trouble, such as front running. I don't want, if I need to guarantee that when I put a report into an AI machine, it does not read my idea that is being published in 2 days' time and to trade on its own. So of course, all this is set up, and all this has legal protections, but there are some catches in the process that need to be assured to work smoothly. But in the end of the day, it will be faster processing of information at a cheaper price. That's the big trend, but with specificities for each one of us.
That's great. I hope, at least for quite some time, AI will not be able to fulfill all our job descriptions. So we can continue to keep our jobs, but do it faster and more efficiently. And so we are reaching the end of the webinar. So I just have to thank you all for listening in, and thank our guests for sharing these experiences and these insights. I hope it has been as interesting to you as it was for me. And hope to see you soon in another CFA Society Professions webinar. Thank you all.
Thank you
very much.
Thank you. Have a nice evening.